Welcome to all of you, Shiksha 360, and today basically we will cover chapter number 6, that is risk in foreign trade, part 6. Clear? Part 6. Clear? Basically, one or two more parts basically we will left, and after that basically we will cover that chapter, and basically we will discuss the questions. Clear? So let's start. Basically, in the previous session we have discussed regarding the basically policies provided by the ECGC to the exporter. Only one last policy basically we have to left for discussion, that is basically policy for SME sector. Clear? Policy for SME sector. So can anyone tell basically what is the full form of SME? SME basically stands here for basically small and mid-size enterprises, entrepreneurs. Clear? Basically small and mid-size. Clear? So basically first question basically they will ask from that basically when this policy was introduced. Clear? Basically when this policy was introduced. Clear? So basically ECGC has introduced a policy basically exclusively for the SME sector units on 4th of July 2018. Clear? Basically on 4th of July 2008. Clear? Not 2018, basically on 4th of July 2008. Clear? Basically this policy, clear? The policy, basically this policy is particularly provides the SME sector easy administrative and operational convenience. Clear? Basically for the SME sector, basically for easy administrative and operational convenience, basically this policy was launched, and this policy also covers commercial and political risks are covered under this policy. The policy period, clear? The policy is for a period of 12 months and the extent of cover here is to be 90%. Clear? The policy period here is to be 12 months and the extent of cover here is to be basically up to 90%. Clear? Up to 90%. Clear? This policy, clear? This policy is meant for exposures engaged in manufacturing activities. Clear? Basically engaged in manufacturing and activities, having invested in plant and machinery, or engaged in export of services. Clear? Basically MSME, either manufacturing or for the service sector. Clear? Or for the service. Clear? This policy is meant for exporters engaged in manufacturing activities, having invested in plant and machinery, or engaged in export of services. Clear? Or basically engaged in export of services, having invested in equipment as per the MSME Act 2006. Clear? This policy can be issued to an exporter qualifying as per the MSME Act 2006. Clear? I think all of you are aware that basically these MSME have introduced new limits. Clear? Basically MSME has introduced new limits basically after the COVID-19 exposure. Basically after the COVID-19, basically they have introduced the new limits. Clear? So now let's discuss basically what are the new limits, because they will definitely ask one question from that. So let's discuss regarding that, and I request all of you please participate. So basically now there is earlier there is service, enterprise and manufacturing. Clear? Now basically they will update regarding that. Clear? Here basically you have to write just type of the enterprise. Type of the enterprise, either it is to be micro or small or medium. Clear? Type of the enterprise, either it is to be small, it is to be micro, small or medium. Clear? And investment. Clear? Now they will write just investment, and third one is turnover. Clear? So basically what is the investment now? Basically as per the new terms of the MSME Act, basically what is the investment under the micro enterprises is rupees 1 crore. And for turnover, basically how we can calculate the turnover, just multiply the investment by 5. It is to be basically rupees 5. Clear? Just understand the investment, basically how much investment basically we will require under the type of enterprises. Basically we will guide you basically how we can calculate the turnover. Clear? Basically how we can calculate the turnover. Clear? Just simple ways. For the small enterprises, clear, the investment is to be 10 crore. And turnover here is to be multiplied by 5, just it is to be rupees 50. Third one here basically for the medium enterprise, it is to be 50 crore. If the investment is to be 50 crore, then basically turnover here is to be rupees 250 crore. Clear? So this is the new limits of the MSME, clear, updated MSME definition, clear. They will ask definitely 1 or 2 questions from these, clear. These limits, these are very, very important for the examination point of view, clear. So let's start our session further. So now till now, basically we have discussed the policy for the exporters, clear. Basically policy for the exporters provided by the ECGC, clear. Now basically we will move towards the financial guarantees, clear. Basically now basically we will move toward the financial guarantee, basically which will be provided by the ECGC to the banks, clear. Provided by the ECGC the banks, clear. Now let's discuss one by one all these financial guarantees, and these are very, very important for the examination point of view, clear, because they will ask questions from these points also, clear. So now let's discuss what is the meaning of that. Basically, while it is essential, clear, while it is essential that exporters continue to get timely and adequate export credit, clear. Basically, while it is essential that exporters continue to get, clear, basically continue to get timely and adequate, clear, basically continue to get timely and adequate export credit, basically both at the pre-shipment and post-shipment stage, clear, both at the pre-shipment and post-shipment stage, so that the best possible potential, clear, so that the best possible potential for the exporters can be realized, clear. So basically here, banks will be willing, clear, banks will be willing to release such facilities freely only if the advances are utilized properly and realized in time, clear. Basically only if the advances are utilized properly and realized in time, clear. So basically here ECGC, with the intention of giving protection to the bankers against losses on account of their financial lending to their exporter clientele, has been given guarantees to the financial institution or banks, clear. Basically what they are saying, that basically like banks are providing funds to the exporters, clear. Banks are providing basically funds to the exporters, basically for what? For doing the export business, clear. Basically here what will happen, basically here the funds of the banks are also in risk, clear, if there is no guarantee, clear. So basically here ECGC are also providing the guarantees, clear, or also providing the assistance basically to the banks, clear, so that basically they will lend freely to the exporters, clear, to basically help in the export business, clear. So basically what they are saying, that basically this in turn leads to an additional security, clear. Basically this in turn basically leads to an additional security for the bankers, and thus translates, clear, basically, and thus translates into adequate financial support to exporters, clear. Basically this in turn leads to an additional security, clear. Basically this in turn leads to an additional security for the bankers, and thus it translates into adequate financial support to exporters, clear, and thus translates into adequate financial support to the exporters, clear. So now let's discuss basically what are the financial guarantees given by the basically ECGC to the banks. So basically ECGC issues, clear. Basically ECGC issues following type of guarantees, basically looking at the various needs of the exporters or financial institutions, clear. So now let's discuss basically what are these, clear. First one is packaging credit insurance, clear. Basically packaging credit insurance is given before the shipment, clear. Basically before the shipment, that is pre-shipment, clear. And basically when we are doing the pre-shipment, basically we are doing that is production or manufacturing of the product. So that is basically export production finance guarantee is also given in that time, clear. Export production finance guarantee is also given at that time, clear. So you can remember that basically packaging credit insurance, basically that is at pre-shipment. Along with that, basically we are given that one more, that is guarantee, that is export production finance guarantee, clear. Export production finance guarantee, clear. Basically we will discuss in detail in the upcoming slide, but remember that, clear. Basically after that, basically when the goods are manufactured, clear, so basically they will go for the shipment, clear. That is basically post shipment, clear. So post shipment export credit insurance, clear. Post shipment export credit insurance, clear. Third one is initially basically pre shipment, and after that basically there is also guarantee on the production, clear. Export production finance guarantee, and after that basically now basically they will move towards the shipment, clear. Post shipment export credit insurance, and then next one is export finance guarantee, clear. Export finance guarantee, that is post shipment, that is goods are exported, clear. Now that is basically comes export finance guarantee, clear. And after that basically our bills or invoices are realized or not, clear. On the basis of that basically they will provide further, that is export performance guarantee, clear. On the performance of the bills, clear. Basically whether they are realized on time or not, clear. That is basically known as export performance guarantee, clear. Last one here is to basically export finance overseas lending guarantee, clear. That is basically we are lending to overseas. So there is one more guarantee, that is export finance overseas lending guarantee. Clear? So basically directly in sometimes basically they will ask in the examination these types of questions, that is basically which of the following guarantee is not included under ECGC guidelines. Clear? Basically, or basically which of the following guarantee is not provided by the ECGC to the banks, or which of the following guarantee is provided by the ECGC to the banks. Clear? So basically it is difficult to remember. Clear? So just simple do one thing like how I am explaining. Clear? First of all, basically we will do the pre-shipment. Clear? Basically before the pre-shipment, basically what we will get, packaging credit insurance. Clear? That is basically for the packaging. Clear? Or for the manufacturing. Clear? Basically while doing manufacturing, basically they are given one more insurance, that is, or one more guarantee, that is export production finance guarantee. Clear? Now basically production is done, basically now the goods are ready for the shipment. Clear? When the goods are ready for the shipment, basically we are providing basically post shipment export credit insurance. Clear? Basically when the goods are ready for the shipment, basically what we will provide, that is post shipment export credit insurance. Clear? Basically when the goods are exported, so basically they will provide the export credit insurance, export finance guarantee, export finance guarantee. Clear? Now basically we invoices are also generated. Clear? Basically how invoices are performed, either they are performed in the good way, that is basically we are getting the payment on time or not. Clear? So basically on the basis of that, basically they will provide one more guarantee, that is export performance guarantee. Clear? Export performance guarantee. And in the end, basically last one is basically export finance overseas lending guarantee. Clear? Export finance overseas lending guarantee. Clear? So basically these are the 6 guarantees. Clear? Basically these are the 6 guarantees which are provided by the ECGC to the banks. Clear? Basically which are provided by the ECGC to the banks. Clear? Hope it is clear to all of you, basically how we can remember all these guarantees. Clear? Now let's move towards the next thing, packaging credit insurance. Clear? Basically packaging credit insurance. Clear? So basically what we have to discuss under that, basically any loan. Clear? Any loan basically given to an exporter for the manufacture, processing, purchasing or packaging of goods. Clear? What is comes under the packaging credit insurance? Either manufacture, second one is processing, third one is the purchasing, or fourth one is the packaging of goods. Clear? So any loan given to an exporter. Clear? Any loan basically given to an exporter basically for the manufacture, processing, purchasing or packaging of goods. Clear? Or packaging of goods, that is basically meant for export. Clear? That is basically meant for export against a firm order. Clear? Basically against a firm order or letter of credit. Clear? Basically against a firm order or letter of credit qualifies for the packaging credit guarantee. Clear? Basically qualifies for the packaging credit guarantee. Clear? Basically it is issued. Clear? Basically it is issued for a period of 1 year. Clear? Basically it is issued for a period of 1 year against a proposal. Clear? Basically it is issued for a period of 1 year against a proposal made for the purpose. Clear? Basically it is issued for a period of 1 year against a proposal made for the purpose and covers all advances. Clear? Basically this policy covers all advances that may be made by the bank during the period. Clear? Basically that may be made by the bank basically during the period to a given exporter within an approved limit. Clear? Basically that may be made by the bank during the period to a given exporter. Clear? Basically during the period to a given exporter basically within an approved limit. Clear? So the claim is payable. Clear? Like when the claim is payable. Clear? Like we are manufacturing the things. So basically when the claim is payable. Clear? The claim is payable in case the pre-shipment credit. Clear? Basically in the case the pre-shipment credit granted is not paid basically within 4 months from the due date of the loan. Clear? Basically the claim is payable basically in case the pre-shipment credit. Clear? Basically in case the pre-shipment credit granted. Clear? Basically in case the pre-shipment credit granted is not paid. Clear? Is not paid basically within 4 months from the due date of the loan. Clear? Basically within 4 months from the due date of the loan. Clear? Just you have to remember here basically time, that is basically after how much time basically we will get basically within 4 months. Clear? After the due date of the loan. So basically export credit insurance for banks. Clear? Export credit insurance for banks, where that is whole term packaging credit. Clear? WTPC. Whole term packaging credit is issued by the ECGC to banks wherein a high percentage of cover is available. Clear? Basically in this basically high percentage of cover is available at a lower premium. Clear? Basically at a lower premium. Since a large volume of business is offered to cover in this guarantee. Clear? Since a large volume of business is offered to cover in this guarantee. Clear? Banks is further required to notify the limit sanction to their exporter customer within 30 days of the sanction. Clear? Banks have to report to the ECGC. Clear? Basically, banks is required to notify the limits sanction to their exporter customer basically within 30 days of the sanction, and banks are required to take the approval of the corporation. Clear? And banks are further required to take the approval of the corporation. Basically, when they will required to take the approval of the corporation, basically if they exceed an agreed value. Clear? That is discretionary limit. Clear? That is discretionary limit, or we can say that threshold limit. Clear? Threshold limit. Clear? Like basically when the amount is sanctioned basically more than a specific limit. Clear? Basically more than a specific limit. So in that case, basically they will need the approval of the corporation. Clear? If they exceed an agreed value, that is basically known as discretionary limit. Clear? So basically one thing I will tell you, basically the premium and cover available basically varies from banks to bank, and it is specially approved or prescribed by the ECGC. Clear? During the annual renewal of the guarantee. Clear? Basically the premium and cover available basically varies from banks to bank and is specifically approved or prescribed by the ECGC during the annual review or renewal of the guarantee. Clear? During the annual renewal of the guarantee. Clear? So basically that is packaging credit insurance. Clear? Now basically after the packaging credit insurance, basically what they will provide you: export production finance guarantee. Clear? Export production finance guarantee. Clear? Basically what it tells, basically this guarantee. Clear? Basically this guarantee covers advances. Clear? Basically this guarantee covers advances. Basically which advances? That is given by the banks against the incentives of receivables at the pre-shipment stage. Clear? Basically this guarantee covers the advances basically given by the banks against the incentives. Clear? Basically against the incentives of receivables at the pre-shipment stage. Clear? At the pre-shipment stage. Clear? So both the packaging credit insurance and export production finance guarantees related to the pre-shipment stage. Clear? This provides a cover. This guarantee basically covers the advances given by banks against the incentives of or receivables basically at the pre-shipment stage. Clear? Like production is done by any basically party one and shipment is done by the party two. Clear? Here basically bank will get the incentive. Clear? Bank will not provide any funding for that basically for the shipment. Clear? Basically for the shipment they will get the funds here. Clear? So basically while that is basically for providing the shipment facilities, they will get some incentives. Clear? Against that, this guarantee is given. Clear? Basically, while the extent of cover and the premium are the same as for the packaging credit guarantee, basically banks have ECIB. Clear? Basically, W whole term packaging credit are eligible basically for the concessional premium rate and higher coverage. Clear? Basically higher coverage and the concessional premium rate. Clear? Basically they have to pay less and the basically cover is more under that. Clear? Basically why I'm not discussing the premium and the coverage, because this is varies from banks to banks. Clear? Because this is vary from bank to bank and very rarely basically they will ask questions from that. Clear? Very rarely. Clear? If they will ask any question, basically we will guide you regarding that. But these are changes yearly to yearly. Clear? But these are changes yearly to yearly. Clear? Because these are simply the terms and condition of the policy. Clear? Now next move, basically now basically pre-shipment is done. Basically now basically we will move towards basically when the goods are exported through the ship. Now basically we will move towards the post-shipment. Clear? Basically what will happen after the shipment of the goods, that is post-shipment. So basically post-shipment export credit insurance. Clear? Now basically we will move towards the post-shipment export credit insurance. Clear? Basically now advances against the export bills. Clear? Advances against the export bills by way of purchase, negotiation or discount or rupee finance by banks. Clear? Are covered under this guarantee. Clear? So what is the meaning of that? Like basically the exporter, basically the buyer has now invoice to the of the goods. Clear? And the time is payable, that is 4 months. Similarly, basically seller now receive basically payment from that. Clear? But one thing, basically, sometimes they will require payment earlier. Clear? Sometimes they will require payment earlier. So they will give the invoice to any other party. Clear? Like we can say that for they visit to the bank that they will receive that much amount. Clear? That is, they will receive that much amount. So presently you give me that much amount, or basically little bit less, and you will take your commission. Clear? So these types of things comes here. Clear? Or we can say that like buyer is visiting the bank, that is they have to pay that much amount. Clear? But they will require some more amount now. Clear? So basically you will take some more, basically we can say that interest payment from me, and please granted this much amount to me. Clear? So basically all these things covered under that. Clear? So basically now advances against the export bills. Clear? That is invoices. Clear? Advances against the export bills, either by the way of purchase, either they are purchasing the bill, or negotiation, or discount. Clear? Little bit some less amount. Clear? Or rupee financed by the banks are covered under this guarantee. Clear? So basically under this guarantee, the exporter should hold suitable shipments or contracts policies of ECGC to cover the overseas credit risk. Clear? Basically to cover the overseas credit risk. Please tell fast, it is clear to all of you basically what they are saying that. So basically export credit insurance basically for the banks, that is whole term packaging credit, is issued by the ECGC on whole turnover basis also, wherein the advances granted by the banks to exporters by way of purchase, negotiation, or discount of export bills, or advances against export bills basically sent on collection are covered. Clear? Sent off on collection are covered. Clear? Basically in this also basically high percentage of cover is available at a lesser premium. Clear? Basically high percentage of cover is available at a lesser premium. Clear? Basically just you have to understand basically what main thing here basically they have to cover, that is basically advances against the export bills, either by the way of purchase or negotiation or discount, or rupee financed by banks. Clear? Or rupee financed by banks basically are covered under that. Clear? Are covered under that. Next, move to the fourth one is export finance guarantee. Clear? Basically export finance guarantee. So basically this guarantee basically covers. Clear? Basically this guarantee basically what it covers. Basically this guarantee covers post shipment advances. Clear? Basically this guarantee covers post shipment advances basically granted by the banks to exporters basically against export incentives, receivables in the form of cash assistance or duty drawback, etc. Clear? Basically this guarantee covers the post shipment advances granted by the banks to exporters basically against export incentives. Clear? Basically against export advance incentives, basically receivables, in which form they will receive the incentive, basically either in the form of cash assistance or in the form of duty drawback. Clear? Either in the form of cash assistance or in the form of duty drawback. Clear? So can anyone tell basically what is the meaning of duty drawback? So basically what is the meaning of duty drawback here? Clear? So basically duty drawback, it is an amount. Clear? It is an amount. Amount is basically what of excise or import duty. Clear? Or import duty remitted on goods exported. Clear? Basically remitted on clear. Basically what is duty drawback? Duty drawback here is to basically it is an amount of excise or import duty basically remitted on goods exported. Clear? Basically remitted on goods exported, that is basically known as a duty drawback. Clear? Now next move, basically we have discussed pre-shipment and post-shipment. Now basically we post-shipment. Now basically we will discuss the performance. Clear? Basically how our invoices are performed. Clear? Basically either we will get the amount on time or not. Clear? So now let's move toward the basically export performance guarantee. Clear? Export performance guarantee. Clear? Basically this paragraph we will directly take from the ECGC. Clear? Directly updated guidelines. Clear? So basically the other are little bit similar. Basically there is little bit changes. So basically we will follow with the updated. Clear? So basically this is akin, that is this is a similar. Clear? Basically that this is a similar to a counter guarantee. Clear? Basically this is a similar to a counter guarantee to protect a bank. Clear? Basically this is similar to a counter guarantee to protect a bank basically against what? Basically against the losses. Clear? That it may suffer. Clear? Basically this is similar to a counter guarantee to protect a bank basically against the losses that it may suffer. Clear? Basically, this is similar to a counter guarantee to protect a bank basically against the losses that it may suffer. Clear? That it may suffer on account of guarantees. Clear? Basically, on account of guarantees given by it on behalf of exporters. Clear? Basically, given by it on behalf of the exporters. Clear? Like in the case of bid bonds. Clear? Like in the case of bid bonds relating to exports on medium and long-term credit overseas projects and projects in India, basically financed by the international financial institutions. Clear? Basically, we have already discussed one thing, that is turnkey projects. Clear? I think all of you are aware regarding the turnkey projects. Under that, basically, we have discussed the example of Jewar Airport. If you are not remember, please revise the chapter number 2, session number 2, clear, of chapter number 6. Clear? Basically, in the case of bid bonds relating to the exports on medium and long-term credit overseas projects and projects in India. Clear? Basically, and projects in India basically financed by the international financial institutions. Clear? That is basically sometimes basically we will term as turnkey projects. Clear? As well as, clear, basically as well as supply to such projects, basically grant is granted on payment of 25% of the prescribed premium. Clear? So basically, how much guarantee is given? Basically, guarantee is granted. Clear? Basically, guarantee is granted on payment of 25% of the prescribed premium. Clear? So the balance basically here, like we can say 100 rupees, 25% of premium basically we have paid. Now basically when 75% basically becomes payable, the balance of the 75% basically becomes payable by the bankers if the exporter succeeds in the bid and gets the contract. Clear? Basically, if the exporter basically succeeds in the bid and gets the contract. Clear? Like we can say that there is an tender issued in the newspaper, like for the construction of a dam. Clear? And basically from overall the world, basically bids are given. Clear? Basically for getting the tender. Clear? Basically they have to pay some specific amount here also. Clear? Basically they have to pay some specific amount also basically for giving bid in the tender. Clear? Basically we can say that. Clear? So basically on that, basically how much guarantee is granted? Basically 25% of the prescribed premium. Clear? And basically the balance basically becomes payable by the bankers if the exporter succeeds. Clear? Basically in getting the bid and get the contract of constructing the dam. Clear? So basically this is basically we can say that export performance guarantee. Clear? Export performance guarantee are also basically on the these things. Clear? On these things. Clear? That is export performance guarantee. Clear? Basically in this also, just basically for the members, basically we will give the example of invoice. Clear? Basically we will give the example of invoice. Clear? Basically how our invoices are performed. Clear? Basically to get it, basically to remember, basically we will give a technique. Clear? So basically this is covered under the export performance guarantee. Clear? Now last one basically we have to discuss, that is export finance overseas lending guarantee. Clear? Basically export finance overseas lending guarantee. Clear? Basically if a bank financing an overseas project. Clear? Basically if a bank financing an overseas project, like we can say that like India is constructing any airport or dam or any other major thing. Clear? In Nepal we can say that. Clear? That is, and funding is provided by the, we can say that from SPA or PNB. Clear? So basically if a bank financing an overseas project. Clear? Basically if a bank financing an overseas project basically provides a foreign currency loan. Clear? Basically provides a foreign currency loan to an contractor, so it can protect itself. Clear? Basically it can protect itself basically from the risk of non-payment. Clear? It can protect itself basically from the risk of non-payment by obtaining. Clear? By obtaining export finance overseas lending guarantee. Clear? It can protect itself basically from the risk of non-payment. Basically how? By obtaining export finance overseas lending guarantee. Clear? And the percentage of loss covered in this guarantee or under this guarantee is 75%. Clear? And the percentage of loss covered basically under this guarantee is 75%. Clear? So basically under that, basically we have discussed all the 6 guarantees basically which are provided by the ECGC to the bank or bankers or banks. Hope it is clear to all of you basically regarding all the guarantees basically which are provided by the ECGC to the banks. Clear? So let's do the revision. Last one here, basically we will discuss the export finance overseas lending guarantee, and before that basically we are discussing the export performance guarantee, basically on the dependence upon the performance. Clear? Basically whether we get the bid, basically whether we will get the order or not. Clear? And export finance guarantee, post shipment export credit insurance, export production finance guarantee, and the packaging credit insurance. Clear? And the packaging credit insurance. Clear? So basically these are the 6 financial guarantees. Basically these are the 6 guarantees basically which are given to the banks or financial institutions. Clear? And before that basically we have discussed one thing, that is basically policy for the SME sector. Clear? Basically policy for the SME sector. Clear? So basically in this session we have discussed all these things. Basically 2 sessions basically we will take more for that, and in 1 session basically we will discuss the theory portion, like basically we will covering, and in 1 session basically we will discuss the MCQs, and we will try to discuss the case study also. Clear? Basically we will provide you 50 MCQs basically after the completion of the topic. Clear? So that you are able to remember all points, and basically you are able to go through all the questions, basically how they will ask questions from that. Clear? And one thing I will tell you, basically if you go through all the sessions very carefully and all the questions, basically 50 questions properly, then you are able to go through the question basically which they will ask in the examination. Clear? You will definitely score marks, like 3 to 4 mark question basically they will ask from this chapter, and you will definitely get the marks from that questions. Clear? So thanks to all of you for joining this session. Hope it is clear to all of you.